Hello guys, in this video we will be finishing the chapter Capital Structure and Finance course of chapter 13 ACCA. So before watching this video, make sure that you watch the previous video, and if you haven't watched it yet, check the description box below and I have linked the part 1 and I have also linked all the playlists. If you would like to solve the exam kit, I have linked the playlist of that also in the description box below. So in the previous part, we had discussed till here. So we saw what a share is, we saw what are the ways using which a company can raise finance, and we saw what equity shares are, and we saw what preference shares are. And okay, take a moment and read this. Okay, so now we will be doing the journal entries and we will be solving all the questions which are there in the book. So before starting, let's see this. Now we know what a share capital or what share capital really means. Let's talk about what issued share capital is, called up share capital is, and paid up share capital is. Okay, so first think about it logically. When a company raises money using share capital, what will the journal entry be? So when I'm raising company, if I'm a company and if I'm raising company, then money will come into my business. So it is going to be debit cash anyway, because cash is increasing in my business, right? So this is my basic journal entry: debit cash, credit share capital. Keep this in your mind. We know that share capital, we know what share capital is. And if we are raising money using the shares, then this will be our journal entry: debit share capital, debit cash, credit share capital. Why are we debiting cash? Because cash is increasing, because I am raising money, and whenever my asset increases, it becomes debit. Okay, now let's discuss a little bit about what face value is. Now there is something called as the face value of a share. The face value is the actual value of a share. If I say that the face value of my share is $4, then this would be the face value of my share. So now there are ways using which you can raise money. So when you're talking about shares, keep one thing in your mind. Shares can never be raised on discount. We can never issue shares on discount. What do you understand by discount? Discount is something which is less than the face value of the share. So if my share value is 4, if my face value of my share is $4, I cannot issue it for a price which is lesser than $4. Why? Because we cannot issue shares on discount. Okay, now we have just discussed what face value really means. Okay, so now what is issued share capital? So a company has a number of shares which they'll be ready to issue to the public, which they would like to issue to the public, which they would like to raise from the public. So that would be the issued share capital. Issued share capital is the share capital that has actually been issued to shareholders. So company sets aside a particular amount which it would be raising from the shareholders. So that amount which it is keeping aside to raise it from the shareholders, that amount is known as the issued capital. Okay, now what do you understand by called up? So let's assume that 10,000 shares and of rupees, or let's say of rupees $10 each. This is the issued capital. I would like to have this much issued capital. I know that this is the issued capital. And what do you understand by called up? Called up is how much money I am calling from the shareholders right now. I am issuing entire $10 per share, but right now I require only $5 per share. So at this moment I'm calling up only $5, and on a future date I will be calling up the rest of the $5. Okay, so that is what called up means. So called up means the amount I'm requiring right now, how much I will be calling right now. So it can be anything. I can ask for $8 now, and I would ask you to pay the $2 maybe next time. Right now I need this much only. In the end you will be paying me $10, but at this moment I'm calling up only $8. What does paid up mean? That's simple. Now paid up is something what actually a person pays. If I have called up $8, but the shareholders have given me only $2, so how much is paid up? $2. How much I have called for? 8. But how much was the actual issued capital, or what was the face value? It was 10. Okay. So called up share capital is the amount of the nominal value which is paid by the shareholder. What is paid up share capital? Paid up share capital is the amount of the nominal value which has been paid at the current date. Okay. Always remember, in the share capital account, the face value or the nominal value of the share only comes. So whenever in the journal entry you have the share capital account, you will always have the face value of the share, no matter what the situation is. Keep that in your mind. Okay, make sure that you're writing these journal entries because it is important for you to make a note of this. Okay, now tell me, if I am raising a cap, if I'm raising 10,000 shares of $10 each, what will be my journal entry? Debit cash, credit share capital. With what value? How much money I have raised? 10,000 multiplied by 10. Right. 10,000 shares multiplied by $10 each. Always face value will only go in my share capital. In this situation, it's okay. 10,000 shares multiplied by $10 each. So debit cash to credit share capital. Okay? Clear? Now tell me something. There is something called as a premium. Now, what do you understand by the word premium? If the face value or the nominal value of my share price is, let's say, $5, okay, and if there are so many people who would like to buy the share, but I don't have those many shares to sell, I want to sell them at 5 only. So what will I do in such a situation? People are so desperate to buy my shares. People really want to buy this company's shares. So people are willing to pay extra money just to take the share. Because there is so much of demand for the share, there are so many, buyers in the market. So people are willing to pay extra, or they are willing to pay a premium to acquire the share. Right. In such a situation, I can charge premium from my buyers. I can charge extra money from the shareholders. Right. So that is what is known as premium. So since there is so much demand, this $5 is the face value. But since there is so much demand, I will be now increasing the price. The face value will always remain 5 only. But I can increase the money. Why? Because there's a lot of demand. So now I am charging $6 per share. The face value is $5 per share, but I am charging $6 because of the premium. So what will the journal entry be? Think about it carefully. Debit cash. Why debit cash? Because cash is coming in. Credit equity share capital. Okay, now tell me, what did I tell you? In the equity share capital, we will always be writing the face value. So tell me what will come here. How many shares? 10,000 shares, right? What is the face value? 10,000 shares multiplied by $5. $5. Okay. So always in the account of share capital, the value will always and always be of the face value or the nominal value. Now, how much cash has actually been raised? You got a premium. You got $6 for the 10,000 shares. So 6 multiplied by 10,000. Okay. Now, is it balancing? Is the debit and credit side balancing? Here we have 6 multiplied by 10,000. Here we have 5 multiplied by 10,000. So there is 1 multiplied by 10,000 which is extra. What are you going to do? Why is it extra in the first place? Because in the share capital we can always have only the face value. So what will you do now? Security premium. You are going to open an account or credit an account security premium, and whenever you charge any premium you put that in the security premium. I hope you understood. Take a moment and revise it if you can't understand what I just discussed. If I am charging premium on my share, the excess money which I will be receiving, the excess money will go into the security premium account. Okay, and in share capital we will always be having the face value. Okay, I hope you got what we discussed so far. So let's go back to the book. Okay, let's do the question. Bourbon Company issued 200,000 25C shares. Okay, 25C is nothing but 25 cents, which is $0.25 at a price of 1.75 each. Take a moment and try to solve it. I'll discuss in a second. Okay. Let's read the question. Bourbon Company issued 200,000 25C shares at a price of 1.75 each. So what is the face value? The face value is 25C. It is clearly mentioned over here, 25C shares. So that is the face value. 1.75 is at what you basically gave in the market. So 1.75 is more than 0.25. That means that a premium has been charged. You know the journal entry now. Now try solving it. Debit cash, credit share capital. Just a second. Debit cash, credit capital, share capital. And credit securities premium. Okay. Rule remains the same. In share capital, always the face value goes. The face value is this much, right? So what will it be? 0.25 $0.25 0.25 multiplied by 200,000 shares. Okay. Now, how much cash has actually been received? How much has actually been received? We received 200,000 shares. $1.75 has actually been received. How much excess has been received? Security premium. How much excess has been received? You received an excess of how much? 0.25 was my face value. 1.75 was what I actually asked for. So my excess would be the subtraction. What is the subtraction of 1.75 minus 0.25? 1.5. Okay, 1.5. I hope you got the answer. Got it? So what did we do? Basically, we, in the share capital account, always the face value only comes, and in these, the excess which we have charged, that comes under the security premium account. Okay. Now we are starting with something called as rights issue. So what do you understand by rights issue? The existing shareholders who are already there, who already have a share of my company, the existing shareholders, I give them a right that they can take newer shares for lesser price. So that is an advantage which I am giving to the existing shareholders. For example, if a person already has 8 shares, then they would be getting 2 more at a price which is lesser than the market price. You get it? If the market price is 20, I can give you at rupees 18 only. You get it? So they can buy it from me at 18 and sell it at 20 in the market. So that is what is rights issue. So what do you understand by rights issue? The offer of new shares to existing shareholders in proportion to their existing shareholding at a stated price, normally below the market price. So there are various advantages for rights issue. Why do we actually do rights issue? To raise money. And if my company is not that famous, if it's not that well known, the new people might not want to buy the shares of my company. But then if I have some existing shareholders and if I would want them to, buy my shares, they might be interested to buy because they already have interest in our company and they have already invested their money in our company. You get the point? So that is what is known as rights issue. Rights issue mean in a particular defined proportion, you give new shares to the existing shareholders at a price which is lower than the market price. A rights issue is the cheapest way for a company to raise finance. A rights issue has a greater chance of success. I told you why. Because of the interest which they already have in a company. Now, what are the disadvantages of rights issue? A rights issue is more expensive than issuing debt. Obviously, equity. It may not be successful. Sometimes it will not be successful. A rights issue is accounted for in the same way as normal share issue and therefore has exactly the same impact on the financial position. Okay. Now, there is one small formula you need to keep in mind whenever you are solving the rights issue question. I hope you are writing everything down and solving the questions along with me. Okay. So when you're talking about rights issue, total number which has of shares which has been issued divided by total which the shareholder already possesses multiplied by extra which now we are giving them. When you do this, you get the number of new issued shares. I know it's confusing right now, but when we solve the questions, you will be clear with it. Okay? For example, if the total issued shares are 1000, okay, and I am giving a rights issue for a person who has 5 shares, I give them 1 extra. So for every 5 shares, I'm giving 1 extra. So 5 he already has, 1 is the extra I'm giving, and 1000 is the issued total. Okay. What will be the formula? Total number. So 1000 is the total issued shares. How much he already has? He already has 5. How much extra we are giving? We are giving him 1. So this formula will give you the new issued shares. When we do the question, you will be clear with it. Okay, let's do the test understanding 2. Upon incorporation in 2004, JD Company, a limited liability company, issued 1050 C shares. Again, 50 C is 50 cents, which is $0.50. Needing further funds in 2005, it made a rights issue of 1 for 5 at 0.75. The offer was fully taken up. Now, what are the accounting entries which are required? Take a moment and solve it and then check it with me. Okay, so what is given in the question? 1050 shares were issued in 2004. That is what is given in the question. So what would be the journal entry in 2004? We raised money, right? And share capital. How much? What was the amount? What was the amount in 2004? This was the face value given in the questions. 50 cents. So this is what happened in 2004. Now let's see what happened in 2005. Going back to the question, they said in 2005 rights issue of 1 for 5. Okay, what does that mean? For every 5 shares they have given 1 on a lower price, which is 0.75. Right, you know how to do the working. What are the total number of shares? 1000. Upon how much they already have? 5. If they already have 5, we will give them 1 more. So what is the new number of shares issued? 200 shares is the new number or the amount which has been issued. Okay, that's understandable. Now they have paid you the extra. How much have they paid you? For 200 shares they paid you 0.75 given in the question. They have paid you 0.75 each. Okay, now how much is the face value? Only face value will go into share capital, we know that. So how much is the share capital? 200 into what was the face value? It was 0.5. So that will only go again. And the excess will go into the share premium account. And share premium account and securities premium account is the same thing. So don't worry about that. That's it. I hope you understood the question. Okay, let's move on. Now, what is bonus issue? Right now, we just studied what rights issue is. Now, let's see what a bonus issue is. So, what we saw in the rights issue is that if you have this much proportion of shares, you get this much proportions of shares on a lesser price, on lesser value, lesser amount. When you talk about bonus, what does the word bonus mean? Bonus means free. When we were talking about rights issue, we were not giving the existing shareholders new shares for free. We were giving them at a lower price. But when it comes to bonus issue, we give them free. For example, if you have 5 shares, we'll give you 2 more shares for free, which means no money is being charged. Whereas in rights issue, money was still being charged, but it was just being charged less. So the issue of new shares to existing shareholders in proportion to their existing shareholding, no cash is received from making a bonus issue of shares. Okay, I'll explain this to you. Now, whenever we were raising money from share capital, what was the journal entry? Debit cash is being received. The shareholders are giving you cash. Credit share capital. Right, this was the journal entry. But when we are talking about bonus shares, what is happening? We are giving the shares for free, which means they are not paying you for the share. So will the cash actually flow into the business? No, cash will not come because we have given it for free. So we will not be debiting the cash account because cash is not coming in. Instead, we will be debiting the share premium account. So you understood? Why am I debiting share premium account? We are debiting share premium account because in bonus shares we are giving it for free, which means money is not being received in the business at all in this transaction. So instead of crediting the cash, instead of debiting the cash, we will be debiting the share premium. I hope that's clear. Okay. Again, share premium or to share capital, this is what we have discussed. Let's go to the question. Okay, GKL Company, a limited liability company, currently has 20,050 shares in issue, each issued for this much. So what is the face value? Face value is 50 cents, which is $0.5, and this is the issue price, which is 1.25, and makes 1 for 4 bonus issue, which means for every 4 shares you're getting 1 share free. Okay, now what are the balances of the share capital and the share premium account? So we need to basically just write all the journal entries. So what is the first journal entry? The initial journal entry. When you are raising money, debit cash, credit share capital. Okay, first, how much money will come in the share capital? We have 2000, and issue price, the face value is 50 cents, and we know that in the share capital only the face value will come. So this is 20,000 multiplied by $0.50. What is $0.50? $0.50 is 50 cents. And how much cash has been actually received? 20,000 multiplied by issue price was 1.25. So 1.25, which means premium money has been received. The face value was just 0.50. So we will credit the share premium because premium has been charged. It's going to be 20,000. $0.25 is the excess. Okay, this is the first thing. What is the next journal entry? 1:4 bonus issue has been taken place. So what was the working note of bonus issue? What are the total number of shares? 20,000. What do we already have? The person already has 4. How much extra are we giving? 1. This is the formula which we saw earlier, right? So what will this be? 5,000. So what are the number of new shares? The new shares are 5,000. I hope you're solving the question along with me. So 5,000 are the new shares now. You got it? Okay. So we know that in bonus issue. Okay. So then what will be the next journal entry? We just saw that it would be debit share premium. 5,000. And you know that whenever you are giving something for free, you will obviously give it at the least price possible. And what is the least price possible? The face value. We know that we cannot issue shares at a discount. So we can only issue it maximum, max to max. The least price possible would be its face value. So we will be issuing it with its face value, which is 50 cents. Right. Why are we debiting share premium? Because we did not get the cash. We just discussed that. We know how we got this. Right? It would have been cash and credit share capital. But since this is a bonus issue, here we are giving the share for free and cash is not being received. That is why we are debiting the share premium instead of cash. Okay, so then we have credit share capital. Again, it's gonna be 5,000 multiplied by the face value 0.50. Okay, now tell me, is there any other journal entry after this? Think about it for a second. Okay, so now what is the question? We need to find the balance of share capital and share premium. So let's find the balance of share capital. In the first journal entry, we had this much of share capital. In the second journal entry, we had this much of share capital. So we have to add this share capital and this share capital. Right, you got it. So I hope you have a calculator. 20,000 multiplied by 0.50 plus 50,000 plus 0.50. So when you add that, it is going to be basically 2,500 plus 10,000. That would be 12,500 is my share capital. 12,500. So this is my answer. Now we know that B is my answer because 12,500 is not in any other option. But we have to still see. Let's solve the premium also. What is the premium balance? Okay. We had a credit balance of this much. And here we are debiting it. Which means we are reducing it from the balance. So 20,000 multiplied by 0.25 minus of what you have debited. What will that be? So the securities premium will be 15,000 minus 5,000 multiplied by 0.5. Okay, this is going to be 12,500 again. So the answer is B. Okay, so I hope you got this. Next question. RIT company is a limited liability company with 200,025 shares in issue. At 1st January, the balance on the share premium balance is also given, which is 75,000. So basically we need to do the journal entry of everything. Let's do one by one. The first line, 200,025 C shares were issued. So let's write the normal journal entry. What would it be? Just a second. Yeah, it would be debit cash, credit share capital. What is given in the question? What is the issue price? 200,000 shares of $0.25 each. Right. 200,000 into 0.25. Multiply and do the totaling by yourself. Next. So we have the share premium balance, which is 75,000. Let's come to that. Let's not do anything about it right now. Let's do this. There was a fully taken up 2 for 5 rights issue at 1.80. Okay. So now we have rights issue 1.80. What was the rights issue? The rights issue is, let's see that again, 2 for 5. So for every 5 shares, you are giving them 2 more at the discounted price or at a lesser price. So what are the total number of, this was our formula, right? What was the total number of shares? 200,000 upon how much they already have, 5. How much extra we are giving? Multiply, which is 2. This is nothing but, I hope you're solving it, divided by 5, which would be 80,000. So this is 80,000 shares. So these are my new issued shares. Okay. What will be the journal entries of this? Debit cash, credit share capital. How much in the share capital? 80,000. In share capital, we will always put the face value. What is the face value? 0.25. Right. 0.25. How much cash has actually been received? We got 80,000 shares prize money and the issue price was 1.80. So 1.80 was the actual cash. So the rest will go into my share premium. What was the balance? 1.80 minus 0.25, which is 1.55. Okay, I hope this much is clear. Now, in the starting of the question, we had 200,000 shares. Now, by rights issue, we issued 80,000 more. So, how much are the total shares now? We issued 80 more. So, now the total shares are 280,000. Right? Keep this in your mind. Now, then we give 1 to 10 bonused shares. Okay. So for every 10 shares, you are giving 1 free. With the formula, let's find the new number of shares issued. So in this case, in the formula, what total will you use? Will you use 200,000 or will you use 280,000? You will always obviously use the new. Right now the total number of shares are these many. So we are going to use 280,000 upon how much they already have, how much extra you are giving. This is 28,000 shares. So my new number of shares would be 28,000 for what? For the bonus issue. This was the journal entry for bonus issue. Right. This would be 28,000 shares. What was the face value? 0.25. Okay. That's it. What are the balances on the share capital and the share premium account? Let's find the balance of share premium. We already, in the question it is mentioned that we already had 75,000 share premium balance, right? So we already had 75,000 balance with us. How much have we used in it? Okay. In the second journal entry, we increased the share premium by this much. By how much? 80,000 multiplied by 1.55. 124,0000. So by this much you increase the share premium, right? You credited it, which means you increased. Now, in the last journal entry, we used up the share premium for giving the bonus shares. How much did we use? 280,000 multiplied. I hope you're solving it. 28,000 multiplied by 0.25, which is 7,000. So you used up 7,000 from the same. Okay. Now let's find this. How much is left? This will be 1,92,000. How much is left? 1,92,000 of the share premium is left. Okay. In the same way, try to find the share capital balance, then you can check it with me. Okay. If you go back to the question, you will see that the share premium balance is 192. So you already got the answer. So you can check this by yourself. Okay. Now what are dividends? We know that if somebody holds a share in your company, you will give them dividend. So if I have a share in a company, they will give me the dividend. It is kind of like the interest. This is something which we have discussed in the previous video as well. So dividends represent the distribution of profits to the shareholder. They are usually expressed as an amount per share. For example, 10% or 10 cent per share. So like that we usually express the dividend. Dividends on preference shares are predetermined. Okay. Now, when I am giving a dividend, that is something I am giving to the shareholder. So it is kind of an expense to the business, and I have retained earnings. So when I have to distribute the dividend, I give the dividend from the retained earnings. You know what retained earnings are. So I use the retained earnings to give the dividends. So since it is an expense, I will do debit retained earnings, and since my retained earnings is reducing, I will debit it and I will credit my bank, since bank money goes out from bank as well. This is the payment of dividend. Any doubt in this journal entry? Payment of dividend. Debit retained earnings because we are reducing the retained earnings, because we are giving away the retained earnings from the we are giving away the dividends from the retained earnings. And credit bank because money also goes out from the bank. Okay. At the end of the year, companies may propose or declare a dividend to the ordinary shareholders. This is a final dividend. These dividends have to be approved at the annual general meeting, and until this point, the company have no obligation to pay them. Therefore, proposed dividends at the end of the year that have not been approved by shareholders cannot be recorded as liabilities at the year end. Okay, so there's a difference between proposed dividend and the final dividend. Until and unless the dividend is until unless the dividend proposal is accepted by the board members, till then you cannot record the dividend as a liability in your books. Okay, what is loan notes? Now loan notes is nothing but loan only, that we have discussed. What are loans? Non-current liabilities, long-term loans. So loan stock or loan note is just loan. So when you take a loan, what is the journal entry? Debit cash because cash comes in, and credit non-current liability. That is what is the general loan journal entry. So that is the journal entry which you'll use for accounting of the loan note, since loan note is a loan which is a non-current liability. Now, whenever you take a loan, you always pay interest on the loan, and you know that interest is a finance charge, right? So interest is an expense to a business. Interest on loan is an expense, and I will debit the expense. So what do I mean by finance charges? Finance charges is the loans which I pay. The interest on the loan, the interest which I pay, that comes under the finance charges. I need to pay a certain amount of charge for taking a loan. So debit finance charges. Why? Because it is my expense. And credit cash or current liabilities. Cash because cash goes out. Current liabilities if I haven't paid it yet. Okay. Custard Creameries is an incorporated business which needs to raise funds to purchase plant and machinery. On 1st March 2005, it issues 150,000 10% loan notes redeemable in 10 years time, interest payable half yearly at the end of August and end of February. So this is something which is known as interim dividend. So what does interim dividend mean? Interim dividend means that you will have to pay half dividend in the middle of the year, half towards the end of the year. So you have to pay the dividend in two parts over the year. That is what is known as interim dividend. Now, let's try to solve this custard creamery question. Try to solve it by yourself and discuss it with me, and you can check it from me. Read the question carefully. Okay, so the first journal entry is going to be debit cash and credit loan notes. By how much? How much loan have you taken? 150, 0, 0, 0, 150, 0, 0, 0. This is a simple journal entry of taking a loan. Redeemable in 10 years of time. Interest is payable half yearly and at the end half yearly at the end of August and Feb. So interest is always paid half yearly at the end of the August and at the end of the February. Okay. Now see this. It is mentioned that on 1st March 2005 you took the loan. 1st March, which is middle of the year, right? Middle in the sense which is not the starting of the year. So let's see this. This is December and this is January and this is Feb and this is March. So here in March you took the loan. So which means you need to pay the interest from March to December. You will not be paying for Jan and you will not be paying for Feb. So for 2 months you will not be paying the interest. From when you have availed the loan, from then only you will be paying the interest, which is how many months? 10 months. So you will be paying interest for 10 months alone. Okay. Interest is payable half yearly. Okay. So let us first find the interest. What is this? 10% loan notes. 10% is the interest charge rate. So what is 10% of 150,000? 10, oh sorry. 10% of 150,000. That was the total. That is the total interest divided by that, which is 15,000. Okay. So 15,000 is the interest which I have to pay for an entire year. Now tell me, I am paying the interest in August and I am paying the interest in February. Okay. For the entire year it is 15,000. So we have calculated in 15,000. Now what will the journal entry be in August? So in the end of the August, how much you have to pay? You have to pay for the March, April, May, June, July, August. For the entire 1, 2, 3, 4, 5, 6 months, you have to pay in August. Right. The journal entry in August would be debit finance charges and credit cash or accrued, whatever. It's usually cash. How much? 15,000 is for the entire year, but in August you are paying only for 6 months. So 15,000 multiplied by 1 by 2. So half of that you are paying over here. Okay. Next. Payable half yearly at the end of the August and Feb. So every August and every Feb you keep paying. But you are making the books for 2005 December. Right. So what will you write in the book? Think about it. So till August you have already mentioned it in the August journal entry. Now you have to, let's just remove this. Now you have to tell me what are you going to do in 31st December. Till August you have already finance charges and credit. Okay. So for 6 months you already paid. After that 6 months are again left. Right. Think about it for a second. You paid till end of the August. So now you have to pay for 5 more months. 5 or 4? Tell me. September, October, November, December. So you have to pay for 4 more months. What was the 15,000 was for the entire year, and now you have to pay for 4 more months. Because this belongs to this year only, right? But when you think about it, you are going to pay it in February, which means you are not paying it in December, but still in December you have to show that this is your accrued interest. Why is it your accrued interest? Because this is something which you haven't paid yet. Accrued expense. Okay, so I hope you understood this, and this will always go into the P&L account, and this will always go into the balance sheet. Okay. Now, if preference shares are redeemable, they are treated the same as loan notes. So we know that this is something which we discussed in the previous video as well, that whenever preference shares are, whenever you can redeem them, then they are similar to the loans. So dividend payments are also treated as same as finance charges. If the preference shares are irredeemable, then it will be treated like equity. Let's see how much of the chapter is left. Okay, let's quickly start with the question. Cracker, a limited liability entity, has a share capital. He has ordinary share capital this much. Okay, keep in mind, in the previous questions we have done, we were always given the number of the shares. Here we are given the total value of the shares. So price multiplied by quantity give you the total value. Right, this is what we used to do. Price of each share multiplied by the number of shares, we used to get the value. But here they have already given us the value. So we need to find out the number of shares. We need to find out basically the quantity using the unitary method. So how will you find the number of shares? It's going to be 200,000 divided by $0.5. Okay, so this will give us the number of shares, that is 400,000. Okay, so this is the number of shares. 400,000 is my number of shares. So how much dividend is being paid in it? Cracker pays an interim dividend of 12.5c per share. Okay, 12.5c per share. So 2 times they give, but they give 12.5 cents for each share. So the total number of shares are this. Shares multiplied by the dividend for one share will give you the total dividend. Okay, so that would be 400,000 shares multiplied by how many dollars? This is in cents. So $0.125. $0.125, that is gonna be 50,000. So $50,000 would be my dividend. Let's come to preference share. 8% preference shares. Okay, that would be 8% of 50,000. What is 8% of 50,000? 4,000. That would be 4,000. So what is the total dividend which Cracker has to pay? This much on ordinary and this much on the preference share, which would be 54,000 total. So 54,000 has to be paid. So the answer is 54. Let's see the value in the financial position. Okay. Before the year, Cracker proposes a final dividend. Okay. In the question, it is said that Cracker only proposes the final dividend. It is not mentioned whether the board people have approved of it or not. Until and unless in the annual general meeting the final dividend is approved by the board, till that time you cannot disclose it as a liability. Right? So the answer is B, where the financial position will have 0. Okay, now we have something which is the other reserves. So we also have other reserves, right? These capital sources, now we know what retained earnings are. What does retained earnings mean? Reinvesting the profit which has been earned this year, putting it back into the business, right? And we also have something which is known as the revaluation surplus. So what is the revaluation surplus? The unrealized gains and everything like that is recorded in the revaluation surplus. For example, when I purchased the land, it was $20,000. Today it is $100,000. So the appreciation in the value of the land, it is not realized until and unless I sell the land. I cannot say that I have a gain, right? So that is unrealized. So things like that come into the revaluation surplus. Cannot be paid out as dividend. So you cannot be using revaluation surplus to pay out the dividends, right? Retained earnings records the total net loss and net profit and can be distributed as dividends. So we are going, if you remember the journal entry, what was it? Debit retained earnings, credit dividend. That was only our journal entry. So we give out the dividends from the retained earnings. Okay, so this is the statement of changes in equity. You have the balance of all the of equity, share capital, premium, everything. Don't get worried. This is something we'll be seeing in detail in the further chapters. And we have all the balances and then the final balance. Okay. Now we have something called as retained earnings. This is something which we have already discussed. Okay. Now we have something which is the income tax. If you can recall from the previous one of the sales tax chapter, we have already discussed what an income tax is, and we know what the over provision is and what under provision is. We know that income tax is an expense and all expenses are debited, and if a liability is created, it gets credited. So think about it. This is something which we have already discussed, so I will discuss it quickly. Whenever income tax happens, my expense is created. Income tax charges, expense, credit, income tax, liability is created. Okay, this is what is a normal journal entry, right? Now, in the case of under provision, the provision you have created was 20, but my actual liability was 50. So in such a situation, my expense increases, right? I have a provision of just 20, but my expense increases. So what will the journal entry be? Again, debit income tax charges and credit income tax liability with the excess. How much more liability I want, that much more I will create again, which would be 30. Okay, now let us take another example. I created a provision for 50, but the charges were only 30, which means I have created an excess liability. In such a case, I will reduce my liability. So what will I do in that? I will just reverse the entry, right? I just need to remove it. I'm going to debit my income tax liability and credit my expense, which is income tax expense, by how much? 20, and I will just reduce it. So this is something which we have discussed, so I'm not going into the detail. Income tax liability to cash, this is when the cash goes out, right? We know this income tax liability, okay. So we know what to do when there is an excess, and we know what to do when there is a lesser thing. Current tax, under or over provision, total income charge. This is what we have discussed even in that chapter, so I'm not going into the detail. Okay, we have two questions now. Let's discuss these. Garibaldi Company commenced trade on 1st January 2004 and estimated that the tax payable for the year was 150,000. Okay, this much tax was estimated. In September 2005, the accountant paid a tax demand of 163. Okay, he had estimated this much, but he actually paid this much, which means there was an under provision in the previous year. You paid extra this year. What does that mean? That means that you have to basically increase the provision this year, right? So what are you going to do in that situation? You are going to debit the income tax charges and credit the income tax liability by the under provided value, which is 13,000. 150,000 minus 163,000, which would be 13,000. I'm just discussing these questions. I'm not going to solve them because you can do it by yourself. Okay, next. So you know what to do. Just do the entry again with the excess money which you need to again charge. At 31st December, he estimated that Garrico owed 165. Okay, just a second. At 31st December, he estimated that Garibaldi owed 165,000 for income tax in relation to the year 31st December 2005. Fine. So now this is just a normal entry again. Debit income tax charges, credit liability 165,000. I hope there is no doubt in this, and I hope you know that accrued interest, prepaid interest, all of that which we have discussed in the previous chapter, keep that in your mind as well. Okay, Chocco estimated last year's tax charge to be 230,000. Chocco's tax advisor settled the amount at 222,000. Okay, which means over provision has been done. So what will be the journal entry here? We will reverse it with the extra so that it gets removed. That would be income tax liability account debit and credit the expense account by the excess, which is 230,000 minus 222,000. I think you can do that by yourself. Okay. This is the previous year's, this year, this much is the tax charge. So that you are going to charge normally income tax charge account debit and credit the liability with this much. And how are you going to show it in the books? Tax expenses, you know what the tax expenses would be for the current year. So just put stuff for the current year, and financial position is the balance sheet. So that's it. We are done with the chapter. I hope you understood the chapter. I know this was a bit lengthy and a bit confusing for some people, but if you keep practicing the questions and if you will watch the previous videos and watch this video again, we will also be discussing the Kaplan exam kit. So everything will be clear by then. Thank you.